After studying this module, we shall be able to understand the relevance of capital structure, know that capital structure is relevant to firm valuation, see how capital structure affects investor returns, recognize the importance of arbitrage process and how this process is being used for making the value of levered and unlevered firms equal. Analyze the various criticisms of this approach.
As we know, the capital structure of a firm is defined as the combination of debt and equity in the total capital of a company. In the process of deciding about this combination, one of the important considerations is the value of the firm. Traditional theories believe that the capital structure has an impact on the value of the firm. In contrast to this, Modigliani and Millar argue that capital structure does not affect a firm's value in the absence of taxes and transaction cost. However, if taxes are considered, then capital structure becomes relevant. This approach to capital structure is explained in the following sections. Modigliani and Millar hypothesize that capital structure is irrelevant for the firm valuation. That is, by changing the proportion of debt and equity, a firm cannot change its value. Firm's value depend on earnings and risk of the assets rather than the leverage or the debt equity ratio. However, it has been argued that capital structure affects shareholders or the investors' returns.
Modigliani and Miller have divided their approach in two propositions. First of all, we shall discuss the first proposition. It states that capital structure doesn't affect the value of firm. This proposition is based on certain assumptions. First assumption is perfect capital markets, whereby investor can freely buy or sell securities, borrow without any restriction as firms, behave rationally, and transaction cost doesn't exist. Second assumption is that firms from same industry also have homogeneous risk classes. Third assumption is there are no corporate taxes, thus there is no tax saving for the firm on interest payment of debt. And lastly, dividend payout ratio is 100%.
This proposition is based on certain assumptions. These assumptions mainly relate to the behavioral pattern of the investors, capital market, firms and tax environment. Perfect capital market. Capital markets are perfect when investors can freely buy or sell securities. They behave rationally. They can borrow without any restrictions as firms, and transaction cost does not exist. The third assumption is very important because if firms can borrow at a cheaper rate than investors, then they can increase firm's value by borrowing. Homogeneous risk. Operating risk is the variability of net operating income of the firm. It is assumed that the firm from same industry also has homogeneous risk class. No taxes. There are no corporate taxes. Thus, there is no tax saving for the firms on the interest payments for the debt. Full payout or the 100% dividend payout. Firms distribute all their earnings after interest as dividends. Thus, the dividend payout is 100%.
Now we will discuss how the proposition 1 works. We know that the value of firm is calculated as the ratio of net operating income to the opportunity cost of capital. Suppose there are two firms, one is levered and other is unlevered. Because of the assumption of same industry and same market share, the net operating income of both the firm will be same before interest and in absence of taxes. Now, as the earning potential of both the firms are same, their risk will also be the same. Thus, the cost of capital will be same. As the operating income and the cost of capital is same, the value of both levered and unlevered firms will also be the same. The diagram shows the proportion of debt in a firm's capital structure doesn't affect the value of the firm. The overall cost of capital is given by a straight line.
So far, we have discussed that Proposition 1 works on the basis of various assumptions of the same return, same assets, same risk, etc. Suppose now the two firms are identical with different capital structures and different market values. In such a case, arbitrage or switching process will start and restore the firms at same level of value. Thus, the investors will engage in arbitrage for their homemade leverage as against corporate leverage, and the values of the two firms will come at the same level. We can understand this process through the following example.
Now the question is why Proposition 1 works. It works because of an arbitrage process. Whenever the value of levered and unlevered firm are different, an arbitrage process takes place due to the value of both the firms comes at an equal level. There may be two cases where the value of levered firm is greater than the value of unlevered firm, and where the value of unlevered firm is greater than the value of levered firm. Let us discuss these two scenarios with the help of an example. In the first case, suppose firm U is an unlevered firm with an equity of rupees 1 lakh, and firm L is a levered firm with an equity of rupees 50,000 and debt of 50,000. The net operating income for both the firms is rupees 10,000. Firm L has to pay interest on debt at the rate of 6% per annum. The cost of equity for firm U is 10% and it is 11.7% for firm L. The value of firm U will be the value of equity and the value of firm L will be the value of equity plus debt. As we can see here, both the firms are identical, but due to cheaper debt, the value of firm L increased by rupees 10,000. Proposition 1 argues that rational investors will undergo an arbitrage process, and the value of both the firms will. Let us say an investor initially holds 10% stake in levered firm, including debt of rupees 5,000 and equity of rupees 6,000, and his dividend income is rupees 700, that is 10% of the total dividends of rupees 7,000. In order to avail the opportunity of making a profit, he decides to convert his holdings from firm L to firm U. He will first sell all shares of levered firm for rupees 6,000, but in order to acquire 10% holding of firm U, he needs total funds of rupees 10,000. So he borrows rupees 5,000, that is 10% of debt of firm L at the rate of 6% per annum. Now he has rupees 11,000. He buys 10% shares in unlevered firm for rupees 10,000 and thus he is left. Now all the rational investors will follow the same arbitrage. There will be the selling pressure on the levered firm which will lower down its market price and value, and buying pressure on the unlevered firm which will increase its market price and value, such that the value of both the firms are brought to an equal level.
Thus, we see that the investor still gets the same return plus extra cash of rupees 1,000 by converting corporate leverage to personal or homemade leverage. Likewise, all the rational investors will follow the same strategy. They will keep selling shares of the firm L, which will decrease its market price, and keep buying the shares of firm U, which will increase its market price. Therefore, the value of the unlevered firm will rise and the value of the levered firm will go down, and there will be an equilibrium after the end of the process of arbitrage.
Now let's consider the second case, where the value of levered firm is less than unlevered firm. Assume that the cost of capital of levered firm is 17.5%. Other things remain same. After working out the calculations, we can see that the value of firm L is rupees 10,000 less than the firm U. Thus, an investor of firm U will try to use this extra value for generating surplus for himself. In this case, reverse arbitrage will take place. Let us say an investor initially holds 10% stake in unlevered firm, that is, equity of rupees 10,000, and his dividend income is 10% of total dividends, that is rupees 1,000. In order to avail the opportunity of making a profit, he decides to convert his holdings from firm U to firm L. He will first sell all shares of firm U for rupees 10,000 and will buy 10% shares in levered firm for rupees 4,000. Similarly, all the rational investors will follow the same arbitrage. There will be selling pressure on unlevered firm, which will be lower down its market price and value, and the buying pressure on the levered firm, which will increase its market price and value, such that the value of both the firms are brought to an equal level. Let us now move on to the second proposition. This proposition states that although the value of firm remains same, but leverage has an impact on the returns to the shareholders. Their returns mainly are calculated by earnings per share or return on equity. With increase in debt, the variability of dividend earnings to the shareholders increases. Thus, they face higher risk, and to accommodate this, they accept higher returns. Thus, returns to investors are higher in levered firm as compared to an unlevered firm.
Thus, it can be concluded that capital structure remains irrelevant for the valuation of a firm. Even if there are differences in the values, arbitrage process brings both the firms at equilibrium. Hence, leverage is irrelevant. So far, we have discussed that capital structure does not affect the value of a firm. But second proposition of Modigliani-Millar hypothesis says that it affects return of the investors, that is return on equity and earnings per share. It says that the leverage increases variability of dividends to the shareholders. Thus, the risk of shareholders increases. Now, to compensate for this increased risk, they expect higher return. Thus, it can be said that with increasing leverage, the risk and return of the shareholders increases. Suppose there are two firms, U and firm L. Firm U is an unlevered firm, firm L is a levered firm. In case of unlevered firm, the weighted average cost of capital will be same as cost of equity because of the absence of debt. However, in case of an levered firm, the weighted average cost of capital will include cost of equity as well as cost of debt, weighted by the proportion of debt and equity in the capital structure. Proposition 1 states that the weighted average cost of capital will be the same for a levered and unlevered firm. As we know that debt is cheaper source of finance, the cost of debt has to be higher to compensate for it. Thus, in case of levered company, the cost of equity is greater than the cost of equity in the unlevered company. This extra value of cost of equity is called financial risk premium, as it arises due to financial risk of the levered firm. Let's discuss it through equations.
Let us discuss how this proposition works. We know that the return to the investors can be measured by return on equity, which is given by cost of equity, that is KE. In case of an unlevered firm, the cost of capital will be exactly same as the weighted average cost of capital. Proposition 1 states that the weighted average cost of capital is same for levered and unlevered firms. And as we know, debt is a cheaper source. The cost of equity in levered firm will be higher. It is shown here that the cost of equity in levered firm is weighted average cost of capital plus some extra value which is called the financial risk premium, which can also be calculated using formula as shown here. To accommodate the increased risk, the return also increases. Let us understand the working of proposition 2 with the help of an illustration. Suppose there are two firms U and L. Firm U is unlevered firm and firm L is levered firm. Operating income of both the firms is rupees 18,000. Firm U has 10,000 shares at rupees 12 per share and firm L has 5,000 shares at rupees 12 per share. Thus, the share capital of firm U is 1,20,000 and of firm L is 60,000. Firm L also has 6% debentures worth rupees 60,000. Now we will calculate the returns of investors in case of unlevered and levered firm to see how it differs. We are using return on equity and earning per share to measure investors' return. Let us first calculate return on equity, which is same as cost of equity. In case of firm U, it is same as the cost of capital, which is calculated by dividing net operating income by the market value of equity. We can see that it comes out to be 15%. Now, as discussed earlier, cost of equity.
Thus, it can be concluded that the return for shareholders in the form of EPS and return on equity or KE increases with increase in leverage. As we know that WACC remains same on changing leverage under proposition 1, it is also important to note that as leverage increases, the cost of debt also increases because of higher risk of default. Thus, the increased required in cost of equity slightly slows down as the cost of debt increases at a decreasing rate. Eventually, with very high leverage, debt holders get a claim on firm's assets. Thus, the business risk of the shareholders is transferred to debt holders. Thus, cost of equity starts decreasing beyond a limit.
Propositions have been widely criticized for its assumption which do not hold true in real scenario. These are: first of all, there are discrepancies in the rate of lending and borrowings due to which investors cannot easily shift their corporate leverage to the home-made leverage. Secondly, the extra return in case of personal leverage vanishes due to the presence of transaction costs. Thirdly, as some of the investors in the firms would be institutional investors, they cannot indulge in arbitrage due to the restrictions. Last is existence of corporate taxes to which levered firm get an advantage. The interest payment is tax deductible. Thus, the net operating income is higher and so is the firm value for levered firms.
The proposition given by Modigliani Millar mainly holds true because of the arbitrage process of the investors. But this arbitrage process may take place only when certain assumptions hold true. If we look at the capital markets, these assumptions don't hold true in real life, because of which arbitrage process can't take place fully, and therefore there exists a difference between the value of the levered and unlevered firm. The following are the criticisms of hypothesis. Discrepancy in lending and borrowing rates. The rates at which investors and firms borrow and lend are different. Firms generally have higher credit ratings than individual investors, and therefore they can borrow at a lower rate. Thus, the assumption on which homemade leverage takes place does not hold true. We can say that homemade leverage is not a perfect substitute for the corporate leverage. No substitution of personal and homemade leverage. Although the net return is same as in the case of personal or corporate leverage, but the risk or liability of investor is different in two cases. In case of corporate leverage, if firm goes bankrupt, then the investor will lose only the amount of his equity shares. But if he has personal leverage and the firm goes bankrupt, he will lose his shares and will have to pay a loan also. Thus, the risk is higher in case of personal leverage. Thus, homemade leverage and personal leverage are not same for the investors. Transaction costs. There exist transaction costs also. Thus, in the process of buying and selling and converting the leverage from corporate to personal, some costs have to be incurred. Thus, the extra return in case of personal leverage vanishes due to the transaction costs. Thus, arbitrage can't take place fully. Institutional restrictions. Institutional restrictions means restrictions on institutional investors on creating personal leverage. As some of the investors in firms would be institutional investors also, they can't get indulged in arbitrage due to restrictions. Existence of corporate taxes. Due to the existence of corporate taxes, leverage firms get an advantage. The interest payment is tax deductible. Thus, the net operating income is higher, and so the value of the firm is higher in case of levered companies. Therefore, the propositions will not hold true in real life.
In this module, we have discussed the two propositions in the absence of corporate taxes, their assumptions, and understood how two propositions work. Further, we have also discussed the ground of criticism of two propositions.
Modigliani and Millar argue that capital structure does not affect the value of a firm in the absence of taxes and transaction cost. The first proposition of hypothesis states that capital structure does not affect the value of a firm. Even if there are differences in the value originally, the arbitrage process brings both the firms levered and unlevered at equilibrium, that is at the same value. The second proposition of hypothesis says that it affects return of investors, that is return on equity and earnings per share. With increasing leverage, the risk and return of shareholders increases, and hence the cost of equity also increases. The propositions given by mainly holds true because of the arbitrage process of the investors. Propositions of hypothesis does not hold true in capital market in real world due to the discrepancy in lending and borrowing rates, existence of transaction costs and corporate taxes, no substitution of personal and homemade leverage, and other frictions in the capital market.